Afternoon, ladies and gentlemen. Very warm welcome to our weekly episode of the market review for the week of 19th of June. My name is Benjamin Goh, the head of research and investor education here at SIAS. And with me is our senior technical analyst, Sunny So. We'll be running through a couple of things that happened this week, as well as what to look out for given the interest rate pause in the US. Before that, let's get to our disclaimer. So the obviously the most important slide is this slide, which is basically to say that SIAS is not registered by MES. We are a non-profit organization. So whatever we talk about today, especially for specific stocks, cannot be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the capital markets. Now, before we get to the content for this week, I just want to let you guys know that the next ASIA session is on the 19th of July. I think that's incorrect. I think it's the 21st of July.
Let me update that. Probably the next one will be the next week, right? Which will be 21st of June.
21st of June.
Correct.
Yes.
So next week, and then after that, the July one will happen on 19th of July.
Okay. This is what happens when you run out of coffee at the end of the dinner. All right, so 21st of June, and this one is obviously correct, but because this is 19th of July. Good stuff. All right, the QR code here obviously is for you to chop your place. This is restricted to members. And do give us a review, hopefully a 5-star review. Obviously, if you like us, you want us, not to be fired, do give us a 5-star review. This is the QR code for that as well. Now, if you are not a SIAS member, we are selling the membership for $1 a month, $12 a year, which is less than the current Grab price if you want to go from my house to Raffles Shopping Center like right now. Okay, so it's definitely cheap. And then, of course, that will give you subsidized pricing for our paid workshops as well as access to our ASIA session. Where you can ask Sunny and myself any kind of questions about capital markets. We don't know anything about cooking or what's the latest movie, nothing about that, but capital markets. All right, again, the QR code to sign up. Now, let's talk about today's content. I'm going to talk about two big pieces of news that came out quite recently. And then Sunny will be talking about the charts. Obviously, that's a little bit more exciting because if you look at the week, last week, right? It ended quite a high note. All right, so let's talk about the Singapore non-oil exports that came out last week. The Singapore May actual number was a negative 14.7% year on year versus the estimated negative 8.1%. So it's worse than expected. And of course, the April's reading was a negative 9.8%. So it appears to be, it's worse than expected and is worse than the previous month. Now, just to put things in perspective, this is the 8th consecutive month of contraction for the non-oil exports. This is definitely not good news. And the non-oil exports for Singapore entered a negative growth territory as so negative numbers since all the way back in October 2022. So that means October 2022 versus October 2021, it was already negative and all the way to now. Now, alongside the Singapore Manufacturing PMI, and again, how this works is that is an index, purchasing manufacturers index. So it's from 0 to 100. Generally, the 50-point mark is the break point. So anything above 50 points suggests expansionary. That means the economy growing. Anything less than 50 points suggests contractionary, so economy not growing, right? So the Singapore PMI, the latest reading was below 50. And it's been below 50 since September 2022, except for February this year, which was exactly 50. So if you take the non-oil domestic exports as well as the Singapore Manufacturing PMI, it paints a picture of, or rather a narrative that really, this is the problem that Singapore has always had. Because we're a small country, very open economy. I mean, we don't even control our own interest rates. Really exposed to the headwinds, which is buffeting the US, Europe, as well as China, and of course the rest of Asia. So all our major trading partners forecasted to have to be entering a slowdown or have already entered a slowdown. China, it's slightly different, so we're going to be talking about it in the next slide. But as you can see, the long awaited recession in the US and Europe is that's still the base case scenario. So more than 50% chance the second half, which is going to be starting next month, for 2022, we're going to see a technical recession in the US. So not to even talk about New Zealand as well as Australia, again in the news recently for GDP slowdown. All right. Okay, so we are going to be seeing this headwinds until the end of the year, which that's when things will start getting better. All right. Now on China itself, last week UBS, Standard Chartered Bank, Bank of America, as well as JP Morgan, downgraded China's 2023 full year GDP forecast. Previously, it was between 5.7% to 6.3%. Now it's between 5.2% to 5.7%. Now again, to put things in perspective, the numbers here actually, I mean, I think the US will kill for this numbers, right? 5%, but we're talking about China here. So historically, the GDP growth has actually been quite high. So this is, as you can see, the Chinese economy is heading down into a different part of its life cycle. A lot of it, or rather about 20 to 25% of the economy is driven by the real estate industry, and that has not been doing well since the blow up with China Evergrande, which, by the way, has not been fixed, right? So the entire construction real estate industry is still not back on its feet, and that accounts for between 20 to 25% of the Chinese economy. Again, from the news flow last week, it does, or rather the Chinese central bank has decreased or rather dropped its interest rates a little bit further to try to pump prime the economy. That is not expected to be that effective simply because people are refinancing at the lower interest rates, but they're not actually spending. Right. So remember in China, people start paying for their flat when they sign a contract, even though the construction is just started, is signed for it. And again, there's previously there was quite a fair bit of speculative activity. So with these lower interest rates, people are expected to refinance rather than to splurge out on more big ticket items. So that is already the trajectory that we're seeing, because the May reading for the retail sales growth as well as capex, capital investments or fixed asset investment, came in below expectations. All right, so already this is kind of the narrative that's forming, does suggest a softening of domestic demand. So if China's domestic demand is softening, then of course you need to look externally, outside China markets to try and push the exports. But the challenge here, beg your pardon, challenge here is that we do have somewhat adversarial rhetoric coming out of US to much lesser extent in Europe. So the geopolitical tensions that China is facing with with its major trading partners is not going to go away because it's like chicken and duck talking. Yeah, so that is probably not going to be helpful in pushing the Chinese economy to higher highs this year. So not good. All right, so that's on the economic front. Now with that, I'm gonna pass the time over to Sunny, because last week's capital markets performance was it was all green, so that'll be a little bit more exciting. And of course, he's going to be talking about the Fed policy and the interest rates.
Yes, so I believe this is the rally that Ben is talking about. It actually happened this week, and yesterday was actually the big rise, as you can see over here on the right-hand side of my trading platform. You can see that Dow Jones is leading the gain yesterday, Thursday night, at 1.26% up, and then S&P 500 1.22. The Nasdaq Composite is up 1.15%. This kind of rally of 400 plus point on the Dow Jones rally has not been seen for quite a bit of time. And then if we are going to scroll back further in time, where are we, or how far are we from the post-COVID high, I would say, which was the beginning of last year? I'll go deeper into that. But first thing first, what was the data that that caused the big jump in the market? And this is what it is. So during the on Wednesday Singapore time, Singapore morning, or Tuesday night US time, Tuesday night Singapore time, Wednesday morning US time. Sorry, I got my time zone a bit mixed up over there. So core inflation rate for year on year for the month of May comes in at 5.3%, which was in line with consensus, and that was also 0.2% below the previous month reading. Okay, so that is a positive sign. So that will give the Fed more room to pause. And then the inflation rate for the month of May also come in at 0.1%, which is lower than the consensus of 0.2 and also much lower than the previous reading of 0.4. And the big headline number, I believe, that's driving the market this week, or at least on Wednesday and Thursday itself, is definitely the inflation rate year-on-year number. That's the headline number, which is down to 4% compared to the 4.9% that was recorded in the previous month in April. So it's close to a 1% drop, and we are getting closer and closer to the Fed target rate of about 2% inflation rate. So we are getting to the point where Fed is going to pause or even start to cut interest rate, which is projected by the the CME Fed Watch 2 to happen likely probably towards the end of the year or even early next year. So the Fed interest rate, so no surprises. The consensus was to leave the interest rate unchanged at 5.25%, and that was the reading. That was the decision for the month of June. However, the economic projections, which I will go to the CME Fed Watch 2 over here, you can see that this is for the month of July. The market consensus now, or the Fed funds pricing now, is the probability is that we will see another 25 basis point hike for the month of July, which will be announced on 26th of July. So now the probability stands at 74.4% that we are going to see a 25 basis point hike to bring the interest rate to 5.5%. Now, what was announced during the FOMC meetings was also the dot plot chart over here. Okay, this was the consensus of what the FOMC participants' assessment of appropriate monetary policy. So we have risen from the previous consensus of about 5.1%, slightly below the 5% mark. Now we have a new dot plot chart which says that the interest rate projection towards the end of 2023 is likely to be slightly above the 5.5% or consensus around the 5.6% level. So judging from the 5.25 that we have now, we could likely see another two small rate hike in the form of a 25 basis point hike, one in July and another one in the later part of the year. So we are not sure of that yet. However, you can see from the probability that I showed you earlier. Okay, so we are expecting at least another 25 basis point hike to happen in the July FOMC meeting announcement. So that will bring us to the 5.5%, just 0.1% short. So that gives the Fed another rate hike to play with should the inflation rate blow up again. Okay, but then, however, I would like to warn as of now, if let's say the economic data that we see over here, the headline inflation number 4.9%, if the trajectory here, I have a mini chart over here on the right hand side, if the trajectory continues to stay the same and then we drop by another 1% next month, then definitely we are getting even closer to the 2% mark reading, and the projection of the 5.6% may not even happen. Okay, so that is why I believe the main reason for the market that is very bullish right now. Okay, so on the technical side, I'll go to the charts now. Go to the charts now. Okay, so this is Dow Jones Index. So yesterday, Thursday night closing, we are up 1.26% or about 428 points. So we are now testing this resistance. In fact, with the closing above this red color line over here, I would say that the double top or the triple top that we experienced this year, the year-to-date high at about 34,280 has already been broken, and we are likely going to test the next resistance level. To me itself, at least when I look at the chart now, the next high will definitely be quite close nearby, which is the December high that we saw last year. This is the December high over here, which is around the level of about 34,700 points. So that is the next close by resistance over here, and that could be the near-term target for the Dow Jones Index. Above that, we might also retest the April high that we saw last year. That is around the 35,490 points. So about 35,500 will be inside once we touch once we breach the December high as well. So how far are we from the post-pandemic high, which was the early part of last year? The highest we reached was about 36,950 points. So it happened in about January of last year. So that is the ultimate resistance I think we'll be looking at. So how should we likely trade the Dow Jones Index going forward? I think I will want to draw some lessons during the COVID rally that you see over here. Okay, so let me just reset the charts and then zoom in. So as you can see over here, this was what happened during the COVID rally. I think one very key and prominent important point you see Bollinger Band or the 20 days moving average in the Bollinger Band. So you can see most of the time when a rally happens, when it pulls back into the 20 days moving average, market starts to bounce back again. So if you have the thesis that this bull market rally is likely going to hold, is it a good time to get in right now? That is the question a lot of investors will be asking about. Have I missed the rally? So I don't think you have. You may have missed some parts of the rally, but it may not be too late to get in. However, if you want to get back in, you will be looking at some level of margin of safety, or what would be an appropriate level to look at. And that the first thing that comes to mind will likely be the 20 days moving average that you see now at the Bollinger Band area, which is around the 33,495 points or 35,000 level. Because at that level now, if I'm going to connect the low in October, in March, as well as in May this year, then it would have formed an uptrend line, and that would have found some confluence with the 20 days moving average that we are seeing now. So that will come in to provide a stronger support for the Dow Jones Index should a pullback happen and the rallies continue to go up further. Then the 20 days moving average would prove to be a point that's worth noting to get back into the rally if you have not get in so far. On the technical indicator side, we can still see that MACD indicator positive reading at 113.92. The gap between the MACD line and SIG line is still pretty significant, and the latest MACD histogram bar shows a dark green bar, meaning that the momentum right now in the Dow Jones Index is still pretty strong. So I'm expecting it to rise further for the next few weeks, at least until before the 26th July FOMC announcement. We could likely retest the December high at 34,700 and maybe even the 35,400 or 35,500 line, which is the April high that we saw last year. On the RSI, the reading now is at 65.28. We have not touched the 70-point mark, which is the overbought signal or the overbought territory. So we still have some room to go up. Hence, I believe Dow Jones Index will still be continuing going up at 65. Is still a positive, healthy momentum reading on the RSI. And on top of that, it is 10 points above the 14 days RSI reading moving average. So that shows that momentum has been increasing in the past 2 weeks at least. So I'm not going to short the Dow Jones Index right now. I may consider a long. However, if it really pulls back to the 20 days moving average, that's where we should stack our long orders going forward for a longer bull run towards the end of the year, hoping that the inflation rate comes down faster. We see our 2% mark set by the Fed, and then after that, we could see some rate cut coming in, which will provide another leg for the index to move up higher. So next, let me move to the S&P 500, which is even more bullish than the Dow Jones Index. So as you can see over here, we have clearly breached the high, which was the 17th August high that we see last year at 4,300. Where is the next target for the S&P 500? You will be asking. So the next target will be the 4,700, or to be exact, the 4,637 points. So where is this reference coming from? It is coming from the high that we saw in the March period of last year. And during that, we had a sell down from 4,600 all the way to 3,600. So that's about a 1,000 point drop for the S&P 500 index from April to July. So a short 3 months period. So this will be the next likely resistance level for the S&P 500. So do we have the strength to push it up further over there? MACD is definitely telling us that it's a yes, because you look at the MACD line and SIG line, is sort of a diverging away from each other. MACD histogram for the past few days has been growing as well. So great, healthy, strong momentum according to the MACD indicator. However, the RSI has already pushed above the 70-point mark, which is the overbought territory now, reading at 76.36. So I just want to move back into history and see when are those times that we have reached the 70-point mark, and how long has the S&P 500 stayed above the 70 point in the RSI in a bull run. So the closest big bull run that we see was definitely during the COVID period. And as you can see over here, okay, during a bull run, the S&P 500 actually breached the 70-point mark during the 2020 September August period, and it hit all the way up to a high of about 82.90. Okay, so this is on a strong bull run. The highest reading that we have was 82.90. So the current reading, okay, so let me just take a reading on the 5th of November for 2021. Also, that was about a 75-point reading on the RSI index. Okay, and now we are at 76. So we have a chance to see if this is a broad-based rally that's going to happen and going to push through something like we see during the COVID recovery. Then potentially the RSI can hit the 80-point mark, and hence I believe the RSI still have some room to go, although it has been above the 70-point mark. Historically speaking, judging from how far the RSI has risen based on the previous rally. So I think for both the MACD is a positive, a big plus, and RSI have a chance of reaching a 80-point RSI reading as per what happened earlier during the COVID period. If this rally is going to sustain, then definitely the next resistance level, 4,700, would definitely be the next target a lot of traders are looking at. However, at that level, which is about 300 points away from what we see from from Thursday, last night closing, then this is a 300 points, so that would be a healthy range. And I believe the 4,700 would likely face a very stiff resistance, and hence if I would manage to get in here, definitely 4,700, I would take some money off the table. However, if a pullback is going to happen, then definitely back to the 20 days moving average, which is the basis of the Bollinger Band. 4250 is the reading right now. That would be a good entry to chase the rally again based on the previous rally that we see during COVID. When a long-term rally happens, the stock price or the index of S&P 500 usually stays above the 20 days moving average, and the 20 days moving average can come in again to guide traders to get back in if there's a pullback happening to chase the rally again. Okay, so lastly, I will touch on the Nasdaq Composite Index. Also pretty massive gain, as you can see. So yesterday gain was about 1.15%. However, it has also breached the previous high that we see in August last year, around the 13,181 points. We are now at 13,782 points. So where is the next resistance for the Nasdaq Composite Index? And that will be the 14,646 point level, which was the high that happened in March of last year. Okay, so from here, 13,700 to 14,600, close to about 900 points gain. So there is still a chance that traders might still get in to push this higher. Okay, although we are at the upper bound of the Bollinger Band, which is normally seen as a resistance level, but on an uptrend, the candlestick of the Nasdaq Composite Index can stick very close to the upper bound of the Bollinger Band for quite a period of time. The MACD indicator now is reading at 46.20, so it's still a pretty healthy reading. Past few days, MACD histogram is also showing growing momentum. Hence, this rally that we see over here is likely going to push through, I believe, going to retest 14,600. And I think in about a month time, 26th July, is where maybe we will see that it gets tested over here, and traders might want to take some money off the table in case there's any surprises in the next FOMC meeting. So that's the MACD indicator, pretty positive. RSI indicator reading at 78, same thing above the 70-point reading already. So in overbought territory now. I'm going to zoom back into history, into the COVID period, to see what was the highest reading we managed to see in the RSI indicator during the rally. And that was during the 2020 period. We reached a high of about 80.28, which is on the 3rd of September 2020. So still the 80-point mark would likely be the resistance on the RSI to look out for. So if you are trading the Nasdaq Composite Index, you might want to change some of the settings on your S&P 500 and your Nasdaq Composite Index, which means the upper bound of that Bollinger, the RSI indicator should be set to the 80-point level instead of 70, because as we chase the rally, the RSI maybe have an elevated reading, and staying above 70 is definitely not a major issue, as we've seen before that RSI has hit the 80-point mark. So definitely the next target for the Nasdaq Composite Index is 14,600, and this rally might likely push through towards the end of the month, or even the middle of next month. So that is my take on the 3 US indices this week. Anything else to add, Benjamin?
No, that's it. So thank you very much for that, Sunny. So thank you very much for joining us for this week's weekly market review. So have a great week ahead, and we'll see you soon.